doing, everybody? This is Dana from Masterland Investing. First of all, thank you guys for tuning in. What I want to talk about today is the do's and don'ts of real estate investing. I've just put a few on the board to go over that I think are real imperative that you really watch it when you're a land investor. These can be costly. Big mistakes that I've made in the past. Try and teach you guys to avoid these mistakes. So let me go over a couple of these, or actually there's a few of these. Always do a title search. That's super important. If you don't do your title search, you open up a can of worms. You can't go by what people tell you. A lot of people say, "Oh, title's clear. There's no liens. There's no encumbrances." You really truly don't know unless you do a title search. You can do it yourself, or you can hire a title company. I preferably hire a title company, especially if it's a little more complicated. But as well, you can do it yourself if you understand the search itself. So that's very important. Always do a title search. The next one, never partner up just for money. I don't know if you guys have ever done it in business. I've done it in the past. Years ago, I partnered up. I needed some money for a real estate venture when I was first getting started. Probably one of the biggest mistakes I ever made, end up in litigation. The problem is that I understood the business. My partner didn't. He wanted to have a say in the transactions. I had a lot of opinion but no knowledge. I made big promises that he'd bring up money to the table, didn't have the money promised. So long story short, be very careful about that. If you really don't have the money, my advice would be to save a little bit before you go into the real estate investing business. Either that or start off with small deals, like a couple of grand at a time. So this way it's more affordable. You can stack up your money as you go. So that's something you need to remember. Third one, always include a feasibility study. When I say include a feasibility study, that's a period of time that's put on your purchase agreement or on the contract that says I need such and such days to go ahead and dot my I's, cross my T's, make sure the property is what I think it is. There's no problems with the property. In your opinion as the investor, you got to know you're going to be able to sell the property. There's no hidden things on the property. You didn't think it was part of a flood zone. You find out actually it's wet. It doesn't always mean it has to be wet to be in a flood zone. It could be a lot of situations, but you know, typically if you don't understand, have somebody walk the property. But most of all, that feasibility study also can protect you if you got a game plan and you find out you can't get rid of the property in time. Basically, the feasibility period will be open-ended, meaning for any reason that you can get out of the contract, get your deposit back. So my advice is always have a feasibility study, and it's feasibility period. I've said in other lessons, typically I'll have that feasibility period go the length of the on and before closing date. For instance, if it's a 90-day close, I like to put my feasibility study right up to that 90th day. That way you have all that time to make sure you got all your things in order. If you can't make the deal, you can always get out and get your deposit back. Next thing, never buy on emotion. Another lesson I've learned years ago, I realized for myself as I made more money, sometimes you get a little soft. You don't become as creative. Sometimes you have the cash just to buy the deals. I bought a few properties on emotion because I felt I needed the properties. I bought a waterfront lot that was Gulf access. I paid like $360,000 cash for it. Wasn't paying attention to the 4-phase real estate cycle. Bought on the higher end right before the went into recession. No sooner I bought it, within a year I realized I probably shouldn't have bought it. I really didn't need it. When I went to sell it, I lost about 100 grand. So I've done that more than once in the past. It's mistakes I won't make again, but I want to pass that on to you guys to save you from making those mistakes. Never buy an emotion. Always do your due diligence. I mentioned that earlier. That's crossing your T's, dotting your I's. Make sure you do your due diligence. You can use a realtor if you do have a realtor on your team, but I would advise to make sure you cross all them T's and dot them I's, because it's your butt on the line. And if you're going to go ahead and promise somebody you're going to purchase something, you got to make sure everything's in order. So you need to know what the utilities are, if it's landlocked, if it's not, if it's a dirt road, if it's a paved road, if there's anything that's encroaching your property. I always advise you need to do a survey on some of the smaller lots, but it's not a bad idea to have somebody walk the property. Due diligence, actually doing your homework, making sure it is what you think it is. So very important. Next one, never ever overpay. When I say that overpay, it falls back into the emotional end, but also it's also what I've included in the other lessons, is establishing the value of the deal, what the value of the property is to you. Typically, you're trying to sell at just about retail or below retail, and rule of thumb for myself is to buy somewhere between 20, 30, 35% of the retail market. Sometimes lower. I've gone a tad higher up to 40, but typically you want to be around 20, 25% of the retail value. If you're buying on the higher end, you don't leave much room for yourself to make any money. It becomes harder to move the property if you pay closer to retail. You're not really a smart investor if you're paying close to retail. So never ever overpay. Always be aware of the 4 phases of the real estate cycle. I can't emphasize that enough. You probably hear me say it in half the lessons. A full cycle is typically anywhere from 12, 15, 20 years of full cycle. Each particular phase of the real estate cycle doesn't happen overnight. There's plenty of warning signs, but as a smart investor, you always have to be aware of the 4 phases of the real estate cycle. I've said it before and I'll say it again. If you really learn the 4 phases, you can make a lot of money in any of the phases, some more than others. But particularly if you're on the higher end, it's going towards a recession phase, you really got to watch your numbers, make sure you have a solid exit strategy, because you get yourself in a lot of trouble. I've said it earlier, you don't want to be holding all the cards, and now you don't have any buyers, and you got to get real creative, and sometimes cost you money in the long run. So always be aware of the 4 phases of real estate cycle, what phase you're in, which direction it's heading, how much time you speculate's left in that particular phase of real estate cycle. That's my lessons for today. Thank you guys for tuning in. I just wanted to go over that with you guys, get you on the right page. Once again, thanks for tuning in. Be kind, be generous, go out there and inspire someone today. Thank you guys for listening. Talk to you soon. Bye-bye.